You are listening to the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Joining me in segments 2 and 3 of today's program is returning guest, Mr. Jeffrey Tucker. Jeffrey is the founder of the Brownstone Institute. The Brownstone Institute is a collaboration put together by Jeffrey, and many authors contribute. I'd encourage you to check it out at brownstone.org. I'll be chatting with Jeffrey about the government money monopoly. Interesting topic. I invited Jeffrey back on the program after I saw an article that he recently authored on the topic, and I know you're going to enjoy my conversation with him. This is the last week you have an opportunity to get our special report titled Probate Avoidance Guide. Again, the report is titled Probate Avoidance Guide. All you need to do is go to the website, requestyourreport.com, and I'll be glad to send you a free copy of this report. And when you request a report, I'll also send you a copy of the revenue sourcing book, as well as a copy of the little black book on Social Security maximization. So again, the website, requestyourreport.com. The Federal Reserve, the central bank of the United States, and if you are a new listener to RLA Radio, you know that the Federal Reserve is a private bank controlled by private bankers. Back in 1913, Congress and then President Woodrow Wilson thought it would be a good idea to put private bankers in charge of monetary policy. Now, the Fed at this point has a dilemma. I would call it a pretty serious dilemma, because recent numbers show that inflation is once again surging. Consumer sentiment, how consumers feel about the economy, is declining. And the higher interest rate environment imposed by the Fed is making homes a lot more unaffordable, particularly for first-time home buyers. So what is the Fed's dilemma? Well, the question is, do they decide to cut interest rates? And if they do decide to cut interest rates to try to make home purchases more affordable, to try to make consumers feel better about the economy, that's going to make the inflation problem worse. On the other hand, if the Fed keeps interest rates higher to attempt to get inflation under control, and I would point out that the current level of interest rates is not subduing inflation, as I predicted here 2 years ago when the Fed started to increase inflation in interest rates. In order to have inflation under control, you have to have real positive interest rates. In other words, you have to have interest rates that are higher than the inflation rate. And while current interest rates are higher than the official inflation rate, certainly we all know that the official inflation rate doesn't reflect our experience when we go to the grocery store or the hardware store. So the Fed can solve one problem or the other, but when they do, it makes the other problem worse. Now, in a recent interview, President Biden complained that private companies are to blame for inflation. He said that corporate greed is why we have inflation. Well, Peter Schiff commented on this and said, where were all these greedy corporate officers just a few years back? Weren't they just as greedy then? Or did they wait until Biden became president and then decide, let's stick it to the consumer? That's really not what's happening. It's monetary policy that's causing inflation. Inflation is driving up the cost of doing business. So to stay in business, companies have no choice but to raise prices. And they're raising prices because they're facing rising costs. Rising labor costs, rising materials costs, and that translates into higher costs for consumers. Corporations were really reluctant to raise prices originally because they were hoping that inflation was going to be transitory, as they were being told. That is not what's happening. In fact, corporate bankruptcies are up year over year by more than 100%. And maybe some of you saw the most recent news. Red Lobster has now closed 87 locations, according to USA Today. These closures came after a restaurant equipment auction company reported that it was going to auction off restaurant equipment from more than 50 Red Lobster locations across America. The liquidator, Tag X Brands, called the sales of the Red Lobster restaurant equipment the largest restaurant equipment auction ever. It's rumored that Red Lobster will also be filing for bankruptcy protection. That doesn't sound like corporate greed. It sounds more like a company that is hurting because of inflation. And we are going to see more of this. And if you're planning for retirement, certainly understanding how inflation will impact your future retirement income and tax plan is extremely important. That's why I would invite you to get this month's special report. It's Probate Avoidance Guide is the name of the report. Go to requestyourreport.com to get that report. And when you request the report, you'll not only get the report, you'll get a box of stuff that will come to you in the mail, a 9x12 box, 2 inches thick. You'll get a copy of the revenue sourcing book, which contains a retirement planning strategy for today's environment that I believe will turn into stagflation. It'll also include a copy of the best-selling Little Black Book on Social Security Maximization. You'll also get a couple of recent newsletters that I have published. It's a box of information available to you absolutely free and with no further obligation. To get all this information sent to you, simply go to requestyourreport.com. The website again is requestyourreport.com, and I will be glad to mail it out to you. I'll be back after these words with my special guest, Mr. Jeffrey Tucker. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Joining me once again on today's program is Mr. Jeffrey Tucker. Jeffrey is the founder of the Brownstone Institute. We'll chat a little bit about what that is and what motivated him to found the Brownstone Institute. But the articles there offer truth and a great perspective. You can go to brownstone.org and check it out. And Jeffrey, thanks for joining us again on the program. Always a pleasure to catch up with you.
It's nice to be here. Thank you.
So, Jeffrey, before we get started, I want to talk about a recent article you did about government money monopoly that I thought was fascinating. I think there are many listeners out there that are probably under the impression that, well, of course, governments have money monopolies. Hasn't it always been that way? And won't it always be that way? What would you say to that?
That is the consensus among most economists in the last 100 years or even 200 years. It's not true. And it's a good example of how intellectual error can just kind of persist due to a lack of vision. Even the best economists were even in the 1930s were still claiming that there could be no such thing as privately produced money, that governments had to run monetary systems, and it's just simply not the case. A good example of even how the best economists used to believe this. I just bumped into this morning the very great and esteemed economist and wonderful man, Swedish economist named Gustav Cassel in 1937 wrote a big article warning the world of the growth of fascism and socialism and war. And he said, we have to limit government planning only to maintaining monetary monopolies. And that's because free enterprise is not good at providing that. And it was interesting to see even this brilliant guy say that. It just shows what a consensus it is. But, it's a little strange because we actually do have historical examples of markets providing money just fine. Just to go back to the founding period in the U.S., and this is all the way true through, I would say, 50 years following the War of Independence, that that most of the currency, or a lot of the currency, a substantial part of the currency stock in the U.S. was consisted of foreign coins, foreign copper, silver, and gold, and they circulated alongside domestic coinage. The reason was that in those days, all existing currencies were, especially following the Great Inflation after the war, were just different names for the same thing. There were different names for precious metals. And so it didn't matter if it was an Austrian thaler or an American dollar. They both had the same roots, uh, from a linguistic point of view, but they were both silver. And so it didn't really matter what you called them because you knew what was the substance behind the coin. So it was very common to see um, systems of money that were not managed entirely by governments. And another example I gave in my article the other day comes from what I consider to be extremely pioneering research by the economist George Selgin in a book that came out. I'm going to say, I forget now the year, maybe it was 2009 or so, called Good Money, where he recounts, and when I remember reading it in draft and just falling out of my chair, but he recounts a very interesting episode in the history of capitalism in the early 18th century, early and late 18th century in Britain, which was the home of the Industrial Revolution, where the Royal Mint would only mint large denomination gold coins because their main purpose was to serve the large scale enterprises like the East India Tea Company and facilitate transactions between countries. And that was before times when masses of numbers of workers were paid in money. It's hard for us to conceive of that because we just take everything for granted. You work, you get paid, that's it. But that wasn't always true. In feudalism, your payment came in the form of a plot of land and security. You didn't really have money. But with the Industrial Revolution, you started getting these elaborate, large-scale factory systems that were opening up in the countryside everywhere. And they needed to pay their workers from day to day, and the Royal Mint was not providing the businesses small coinage to pay their workers. And they begged and they begged and they begged and they pleaded, but the Royal Mint would not adapt because it's typical with governments. They don't adapt to the needs of the people. They just keep doing the same stupid thing they've always done. So as a result, there were various button manufacturers in Manchester and elsewhere that converted some of their facilities to become coinage production units. And they used, instead of gold, they would use silver and copper and sell the resulting coins to the business owner who would use them to pay their workers. They had a really good system, and these button manufacturers became coinage companies and started hiring a lot of workers, and it became a thriving industry. And this industry was born about 1700 and lasted all the way through to the early part of the 19th century. And it became very elaborate, and very big, and very wonderful, and everybody liked it. And the coins were inflation-proof because they had really clean ridges on the sides, and they're very beautiful, and they celebrated artists and poets and literary figures and nobility and so on, and it was going very well. The Royal Mint got word of this and blew the whistle, said, this is not working for us. as a government, we have to have complete control of all the coin of the realm. So they lobbied the parliament, and the parliament passed an act in 1813 that absolutely made illegal everything except coinage from the Royal Mint. So,
Jeffrey, I'm up against a hard clock here, but I want to pick this conversation up on the other side. My guest today is Mr. Jeffrey Tucker, founder of the Brownstone Institute. Brownstone.org is the website. I'll continue my conversation with Jeffrey when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I'm chatting today with Mr. Jeffrey Tucker. He's the founder of the Brownstone Institute. I'd encourage you to check out their work and all the contributing authors there. Brownstone.org is the website. And Jeffrey, when the clock so rudely interrupted our conversation at the end of the last segment, we were talking about the fact that in 1813 there was a law passed by Parliament that said, we don't like the competition, essentially. You've got these factories producing copper coins, silver coins, and enough is enough. And that's certainly reminiscent of just about every government throughout history, isn't it?
Yeah. So that's the essential message here. I mean, in other words, if you just leave the markets alone, the markets will produce their own money, and everybody's going to be happy with the results. And everybody was happy with the results. But everybody except the government. The government likes this money monopolies because they want to maintain a control over taxation, and they want to develop close relationships with the banking sector, which they rely on to buy government debt in an emergency that they create by spending too much money. So that's always been true. That's always been true. And having the monopoly on currency, of course, allows them to inflate the currency when the population gets tired of being taxed so much. So that's modern history in a nutshell. Over the last several hundred years, and what's striking about it to me is that this history is so not reported. It's not well understood. This book by George Selgin I'm telling you, it's a masterpiece. It's called Good Money. And it's just filled with color photographs of these coins and detailed history of all this. It's an absolute masterpiece. When I read it, I just couldn't believe my eyes. And I think he should have gotten the Nobel Prize for that book, But instead, it wasn't widely reviewed. Hardly anybody paid any attention to it. It didn't sell very many copies. And, it just sort of came and went. It's just sad. I mean, it's sad to me because the really great scholars in our time just don't get the attention they deserve. So, I mean, this book should have been sent to every member of the Federal Reserve. I'm not sure it would have been any good, but it should have gotten a lot more attention than it did, because it came out probably 10 years or so before we got our own new digital currency in the form of Bitcoin, and once again, humanity was presented with an option. You could just let it go and let things develop as seems normal, and just let people figure out how to change dollars to Bitcoin and back again, and just let it be free. But they couldn't do that. So ever since 2000, 2010, or I guess it was 2009 was the first. I think I got that wrong in my article. It was January 2009 when Bitcoin was first released. But, over the last 15 years has been just a history of governments cracking down on it, taxing it, monopolizing the on-ramps and off-ramps, imposing know your customer rules on wallets, you name it. And as a result, they've created a huge mess, all in the interest of maintaining their monopoly over the currency. So we're seeing a repeat of this history of the Royal Mint and 1813. You see how it works? It's always been the same thing. Markets try to have their own money. It's a normal good. It's something that thriving economies need, and markets are perfectly capable of providing it, and they have been for forever. But governments don't like it, and so to me, this is an essential conflict at the heart of industrial history that not many people write about or talk about or understand.
So, Jeffrey, given where we are today, you just mentioned Bitcoin. We've got Bitcoin. There's a myriad of other cryptocurrencies. We have the U.S. dollar that has been severely devalued, also weaponized. I think it's pretty obvious now that the sanctions against Russia have failed. Please jump in if you disagree. And now we have the BRICS countries talking about a gold-backed trade currency. We've got a number of countries bypassing the dollar in international trade. It seems like the world is kind of scrambling for a currency that they can really feel good about. And it seems like there's just a lot of confusion out there right now as it relates to currencies. How do you see all this playing out over time?
Yeah, I think the emergence of these enormous trade blocks around the world, and they're big trade blocks. There's two big ones, BRICS and the dollar. But there's a lot of trade blocks within those, and each one of those has their own plans for currency reform. This is the cutting edge of policy today. The Federal Reserve and everybody associated with that enterprise is very interested in imposing a central bank digital currencies. In other words, they want their own private or Fed-based version of Bitcoin to enable them to track and trace all transactions, to program the money to go on and off, depending on political compliance, and to impose limits on carbon consumption. So that when you use your credit card, if you're trying to take a big trip to Spain, they won't let you because you've already used your allocation of carbon credits, and so on. So this is the system that they want. But you're right. This is the attempt to give us a central bank digital currency is taking place at the exact same time when the world is trying big experiments to get away from the dollar entirely, because with the dollar comes political control. So this conflict and this argument is part of the backdrop of the story of our times.
So, Jeffrey, you brought up central bank issued digital currencies, and certainly some of the control aspects of that, as a freedom-loving American, I find to be absolutely frightening. But do you think that this will ultimately be successful? I've had differing opinions among a number of the guests that I've interviewed here. What's your take?
Yeah, it's very difficult to predict on that. The one thing I would say is that there's more opposition to it than I would have expected, and I'm glad about that. But whether or not the opposition's strong enough to stop it is another issue. You can see all the signs are pointing to the fact that the ruling elites, the monetary and banking elites, believe that this is inevitable, and they just see their job as to slowly rolling us into this system, and they're doing everything possible to make that happen. So the only thing that's going to stop it at this point is a public that's aware of the problem and intolerant towards it. I would say this, that these are not very good conditions under which to try to unfurl this new fancy technology, because masses of people have lost trust in the media and in government and everything associated with that. So people are very suspicious of basically anything that's being pushed by mainstream opinion in this country, and that's true in many parts of the world. So the conditions are not very good right now for a monetary reform on the scale. But I will tell you that the monetary, financial, banking elites have won every one of these struggles for centuries. So, and in our own country, they keep winning. And since FDR confiscated gold in 1933, they've been winning. So they have every belief that there's nothing that anybody can do to stop this.
So, Jeffrey, the time we have left, one more question here. Do you see the Fed cutting rates this year?
They said they are going to try, and the plan has been now for the better part of 2 years to get those rate cuts in place before the election, with the theory that a rising stock market and phonied up GDP numbers will help Biden, who is the candidate for the administrative state and the deep state, and all these people are terrified of Trump. Not because there's no way we can know what exactly Trump will accomplish in office, but they're just much more comfortable with Biden. So the plan has been to cut rates, but that plan, so it's a strange plan because the whole point of cutting rates has always been that the economy is slipping into recession, so we need to prevent that with our magical rate cuts. That's been the line, but you can't really do that with any kind of and maintain your credibility or sense of custodial responsibility over the dollar when you have inflation raging, and at the same time your Treasury Department and all the major news media is proclaiming that the economy is doing very well. So they need two things to happen at the same time in order to enable these rate cuts. They need to see inflation fall, and it's not really falling. It keeps just persisting, and people are getting angrier and angrier, and it's crushing small business. And consumers are pretty well at the point of being spent out. They're kind of done with the whole thing. I mean, the credit card debt is just soaring. Savings are depleted. And you can see when you look at the prices of mainstream outlets like Starbucks, the people are just not willing to spend more and more and more. So there's that problem. The other problem is that for the last 6 months, the Biden administration has proclaimed a glorious recovery. Well, if the recovery is so great, why would you need to cut rates? So I don't think it's a coincidence that with the latest jobs numbers, and these jobs numbers are always a big phony baloney anyway. I've lost all confidence in them. In fact, they're so full of lies that I can barely bring myself to even look at the press releases anymore. But the most latest jobs release said, the numbers are disappointing. And the Wall Street Journal is saying, the growth path is not as certain as we thought. We think we might be headed to hard economic times. So you're starting to see these new warnings of a coming recession. I can promise you, Dennis, there's only one reason you're hearing about that right now, and that is to create a fertile ground for the Fed to cut rates. They need to accomplish this before the end of the summer, or the clock runs out.
I couldn't agree more. My guest today has been Mr. Jeffrey Tucker. He is the founder of the Brownstone Institute. If you're not familiar with the work of Brownstone, check it out at brownstone.org. Jeffrey, thanks for joining us today. I always appreciate your time, and I know the listeners enjoy our conversations as well. Love to have you back down the road. Thanks for joining us today.
Thank you, Dennis.
We'll return after these words. You are listening to RLA Radio. I'm Dennis Tubbergen, your host, and thanks again to Mr. Jeffrey Tucker for joining us on today's program. If you're just tuning in and you have not yet requested the special report titled Probate Avoidance Guide, you can go to requestyourreport.com and request the guide. And when you do, I'll send you a big box of information, 9 by 12 by 2 inches. In the box will not only be the Probate Avoidance Guide, there will also be a copy of the Revenue Sourcing book, which contains a retirement planning strategy for the current economy that I believe will eventually evolve into stagflation, which is inflation in things we buy, deflation in things we own, and a contracting economy. You need a good plan to navigate this as you approach retirement, and the box of information you can get by visiting requestyourreport.com will help you do that. In this segment, I want to talk a bit about debt. Debt is the biggest headwind the U.S. economy is facing. U.S. households now, according to the New York Fed, in the first 3 months of this year, in the first 3 months of 2024, total household debt surged to a fresh record high of $17.7 trillion. That's just household debt. That was up $184 billion from the prior quarter. Now, that amount of debt may not seem like like it's all that practical, like it's all that relevant to you, but let me put that in perspective. That $17.7 trillion in debt is about half of the national debt. And the national debt, when broken down to debt per tax return, it comes out to about $1.5 million per tax return. That puts it in perspective. So can that much debt be paid? It cannot be. And the delinquency rates that we're seeing on consumer debt is starting to reflect that reality. The proportion of credit card balances in serious delinquency has risen to the highest level since 2012. The flow of credit card debt moving into delinquency hit 8.9%, call it almost 9% in the first quarter if you annualize it. That means almost 1 in 10 Americans with credit card debt are delinquent on their debt. They are not making even the minimum payments. Now think back to 2012. In 2012, we were just coming out of the Great Recession. The Fed had just started down this path of quantitative easing or currency creation. And now we're back to where we were at that point when it comes to credit card delinquencies. And consumer debt is higher. Now, of course, if you use a credit card, it's obviously very smart to pay them off in full every month to avoid interest charges. But according to the latest statistics on credit cards, 44% of all cardholders do not pay them off every month. So about 1 in 2 cardholders carry debt. And that, of course, is expensive. Interest rates on credit cards are now also near all-time highs. According to Bankrate, the average credit card interest rate hit a record of 20.72% recently, about 21%. The prior record was 19%, and you have to go all the way back to July of 1991 to find it. Now, as an example, at that rate of interest, 20.72%, if you owe $5,000 on your credit card, which is less than the average American owes, if you make the minimum payments, it's going to take you 279 months to pay off the $5,000 in debt, and you'll pay $8,124 in interest to do so. So the $5,000 credit card debt balance will translate into a $13,124 payoff over 279 months. And incidentally, that's more than 20 years. Americans are not only getting behind on their credit card debt, but auto loan delinquencies are also rising. The average monthly car payment jumped to $738 in 2023, and now about 3% of auto loans are 90 days or more delinquent. That's about 3 million cars. So we're starting to see the cracks in the proverbial foundation when it comes to consumer debt. So we're seeing, again, as we talked about, a dilemma. The Fed has increased interest rates. They've done that to get inflation under control, and the result has been it costs a lot more to carry debt, and we're seeing rising delinquency rates. If the Fed reverses course to make consumers maybe more comfortable in managing their debt, now they're feeding inflation. So the Fed, as I mentioned in the first segment, has a dilemma here. And there is not an ideal outcome. There is not a solution to this problem. That's why I believe we're going to see this end in stagflation. In fact, we're certainly on that path now. That's why I would invite you to get more information. I'd invite you to educate yourself. I would do your own research. And to that end, I would invite you to go to requestyourreport.com and request my probate avoidance guide, as well as all the ancillary information I'll send you. You'll get a copy of the revenue sourcing book, the little black book on Social Security maximization, as well as a couple recent newsletters. That is at the website, requestyourreport.com. That's all the time I have for this week, but I'll be back again next week.